Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and today is Friday, August 22nd, and it is currently 1:36 p.m. Pacific time. The market has been closed for a little bit now. So this is August 22nd edition of Investment Friday. And I'm here with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. I am getting over a summer cold. Who needs that? So if you hear sniffles, that's just me. I apologize. But we're here because there's important stuff to talk about. So, Brad, how are you feeling? I hope you don't have a cold too.
I am actually feeling well from all the health issues I had over the last couple of weeks with a respiratory illness. So I'm feeling great, actually.
Great. That's
So I
right. You move
apologize
on.
to you for feeling great when you feel terrible.
Right. I think it's, all of my kids are in school now, and two of them came home with like doing the thing, like, come on, guys.
It's that time of year.
Mhm.
It's not just the season of spend right now, but it's the season of immunity rebuild because
Great.
your kids bring home all the different infectious diseases that are circulating around the community, and it's just going to build your immune system. You're going to feel great in a few weeks.
Right. Just go buy your pharmaceutical, boosting the pharmaceuticals across the board. Well, today actually the stock market is up like crazy. I mean, anywhere from 1.5 to nearly 2% on the major indices. Accounts looked fabulous today. You log in, go ahead, go look if you want. I mean, it looks great today. But why? What's happening?
It's a great question. Yeah, to your point, the S&P 500 was up 1.52% today, but that does not tell the whole story. The Russell 2000, which has been a perennial laggard for the past 5 to 10 years, small caps have not done very well, is up 3.86% today.
Well,
Now, why are we having these strong reactions in equity prices? Well, the Federal Reserve's Jackson Hole Economic Policy Symposium is taking place right now in Jackson Hole, Wyoming. And during that, we had Jerome Powell, the chairman of the Federal Reserve, and the chair of the Federal Open Market Committee, which is the committee that sets interest rate policy, gave a speech, gave his keynote speech. And in that speech, he seemed to be more dovish about interest rates, which means what? It means the higher likelihood that the Fed is probably going to begin lowering interest rates here at their September meeting and possibly with follow on in November and December. Again, right now, that was pretty much priced into the marketplace prior to this meeting or prior to today, but that speech just kind of put the nail in the coffin, sealed the deal. And so traders, particularly stock traders, really got involved and in the market. Additionally, the bond prices went up a lot. So yields went down, bond prices rallied up, and that has been one of the problems over the past couple of months is with the expectation of lowering interest rates, the really short end of the curve, which is very sensitive to those interest rate changes, was still at a low level, but the longer term yields, which are influenced by effectively inflation expectations, were still a little elevated, relatively speaking. And so, with that speech today, those yields on the longer term came down and their prices rallied.
And just as a reminder on bonds, when the price of a bond goes up, then the yield on it costs more to buy that bond. We'll say par is always 100 for a bond, right? So if the price goes up, and you're getting 5% yield on a bond at par at 100, we'll say $100 just to make it easy. If the price goes up to $105, you're now paying more. You're paying $105 to get that yield. So now the effective yield is lower. And so that's the inverse relationship between the price of the bond and the yield that you get. So the coupon still is five, says 5% on it, but it's 5% of that 100. It's not 5% of 105.
Correct.
So that's the difference. Just like if you go the other way, if bond prices drop, if you're paying $95 for that $100 bond, then the equivalent yield is higher.
Yeah, and one of the things that people forget when they hear interest rates are going up and down, they think it translates into their mortgage or
Right.
mortgages they possibly could do. And it doesn't translate that well only when the 10-year treasury yield, which is basically the yield upon which all most mortgages are based, if that changes, that can change the future of mortgages. So today, for example, the 10-year treasury yield went down, so the price went up, and it went down a decent amount. Okay, so which means what? Mortgages today are costing less than they were yesterday.
So, so this is super relevant. I mean, one for me, my mortgage that we just got is at literally 6.99%,
So
which is
not seven.
not seven, but 6.99. The highest mortgage rate we've ever had. And I mean, this is our fourth home that my husband and I have purchased together. So it's 6.99%. And that was without buying any points down. So I'll say that too. We didn't buy any points down because we also, seeing that interest rates should be coming down over the next year or so, like, well, we're not going to buy any points down on the mortgage right now and spend that money up front if in potentially 12 to 18 months we can refinance and get a lower rate. Is that looking like it's actually maybe going to be possible given the interest rate cuts that are forecasted?
Possibly. Possibly. And the reason why I'm saying possibly is because I know whatever answer I give, it's going to be wrong right now.
Fair
Um,
enough.
yeah. So the reason I'm saying possibly also is because it really depends on inflation expectations. Right now, the official inflation statistics are still elevated compared to where the Fed's target range of 2%. So they're a little higher.
Hmm.
We still have the tariffs. We're still in that year where the tariffs are still having an impact on goods inflation. That has been offset quite a bit by um, slower inflation in the services area of the economy, which is bigger than the goods part of the economy. So that disinflation has been offsetting a lot of the higher inflation in goods prices. Now, every household's different. If you spend a lot more on goods relative to services, your inflation rate will be higher than that. But for the overall economy, that's kind of where we're sitting. Um, so if inflation expectations start to become more moderate because we see, labor market continues to loosen up and to weaken, we see economic growth continuing to soften, then more likely than not, you're probably going to have a better rate 12 months from now to refinance than you do today.
Okay. Well, we'll see. I'll let you know in 12 months.
That sounds fantastic. As
I'll
long
let
as
you
it's
know as
lower than
soon as I'm going to
699.
refi.
Yeah.
Yeah, right. Even in the fives would be helpful at this point. And I mentioned that because I mean that's not just me. That's
Oh, that's tons of people. I mean,
lots of people are in that boat.
yeah. I mean,
Um,
now to be fair, a 7% mortgage rate is it's an average rate over a long period of time.
yeah,
It's just
historically.
over the past 10 to 15 years, we've been spoiled with really, really, really low mortgage rates, which are indication of an unhealthy economy. So let's put that into context. It's an indication there's something wrong in the economy if interest rates are so low. It means there's a real problem. Um, and so it's normal to have kind of, 5 to 7 to 9% mortgage rates and interest rates. So, you know, just it'll be okay. It'll be okay.
We'll work through it. And moving from there, I wanted to go back to something that we started talking about last week, and we touched on just at the end of the podcast. And I wanted to dive in a little bit more, which is the AI data center
Mhm.
and utility company connection that people have been experiencing. And found out I learned something new this past week too, that different private equity firms, BlackRock, Blackstone, have also been buying utility companies as well, or have started to. Maybe not a lot in the last several years, but with the projected growth in AI and the need for AI data centers and data centers in general, private equity is now stepping in, right? Because there's where it feels like there's a big gain to be had. Private equity will be there. So one of I mean, the concerns that people have been having are that rates have been going up, utility rates have been going up, water rates, electricity rates in these communities around the data centers because they're getting, and we talked about this last week, that they're actually getting preferential pricing treatment in a lot of these communities for electricity, for water usage. And so residents are paying more for not using any more than normal, right? Their bills have just been going up. So I was, yeah, just curious to dive into that a little bit more, and just talk about some of the ways that are being proposed that we fix the situation, because it's not sustainable for AI data centers to come into communities and just basically take over the grid and the water system and not leave enough for residents, right? Like that's, we literally can't sustain that. So what's next? What's coming?
Yeah. So in the short term, that's kind of what's going on a little bit.
Hmm.
But we have to remember that utilities are regulated industries. They're regulated by their states, and they cannot increase prices beyond a certain amount in any community. Okay. Um, the problem becomes is we haven't really built a lot of power generation capabilities over the past 10 to 15 years.
Hmm.
And yet now artificial intelligence, data centers, robotics, electrification of our cars and our transportation, all of these things mean much, much, much more electricity needs to be generated. And utilities need capital to invest. I mean, to build a power plant is not a cheap nor a quick undertaking. And so utilities will not undertake that venture until they can be guaranteed or have a very, very high likelihood of having it pay off. Okay. So if people remember the 70s and 80s, there were a lot of power plants that were built that were then shut down, and they were considered stranded costs, which were basically it was not economically viable to actually build this thing. It took so many years. The market changed, and so now it's not worth producing, and so we're just going to shut it down. That's unfortunate, but a lot of utility managers and leaders and CEOs have a little bit of that mindset of, okay, great, our demand for our electricity is going up really, really quickly. What do we need to do? And so they're trying in a short term to fit both demands, both for the residents who need electricity for their households, businesses that need it, but also to be able to supply these data centers, which take an enormous amount of energy. Um, so that's what's happening. Is PE getting involved? Absolutely. With any place that in the economy that needs funds, that returns look like they're going to be better than the average, you're going to have hedge funds and private equity get involved. Just that's just the way it's going to be. They got involved in the in the residential housing market in 2008, 2009. They were very involved in buying up a lot of houses for rents. Um, and there's still heavy players in a lot of those areas. But now utilities, because utilities lack the capital but have the need, they're buying and supplying a lot of capital to those power companies to increase the power generation. Um, so is it is it an opportunity? Yeah, I think it's an opportunity. I think that private equity companies can get paid quite nicely for investing or co-investing with utilities in power plants. There may be certain constructs where the power plant is owned by the private equity corp, but the utility manages it and buys all the power from it and then resells it to the AI data center. Um, I have yet to see some of these deals come out and the actual specifics of their constructs. So I've got to look into that a little bit more. But my guess is we're just about to kick off maybe a decade long power build in the United States, particularly because our current grid is terrible. It's
Right.
old, it's decaying. And so a lot of these AI power plants, or AI data centers, what they're doing is they're co-locating next to existing power facilities, or they're building new power plants right next to them. For example, um, in um, in the middle of Utah, in central Utah, there's a proposal for a 20 million square feet data center facility, which is co-located. They're also going to build a natural gas fired power plant, that will provide power to the AI data center, but also to surrounding communities.
So, and that piece is what's really different in that proposal, I think, than, for example, the one that was just shot down in Tucson. So I think we talked about this
Yep.
slightly last week
Yep.
that there was a proposal, was it Amazon, um, that was proposing a data center in Tucson, close to the Palo Verde nuclear plant. Um, but oh, um, but residents, the way that it was going to hook into the grid was going to heavily affect residents' electric and water, which in Tucson and anyone who's in Arizona knows that water is very extremely precious.
At a premium.
It's at a premium already because we don't have enough. Um, excuse me, I'm choking over here. I'm good,
Don't choke.
right? But that was a big piece of the problem was that there wasn't additional power or water being
Offered.
offered to offset what was going to happen. So how often is that? How common do you think it'll be to pair those things in the future?
Almost 100%. Like almost to in my expectation, it's almost 100%, which is why like the plans for the one in middle of central Utah is really critical because they have already planned for that power source. Um, I think it's interesting that Tucson, Palo Verde already generates a lot of electricity. There's a couple of natural gas plants out by Palo Verde. In fact, that quadrant in Arizona, I think, produces the fifth largest amount of electricity in the entire United States. So
Well,
there's a lot of power generation there. My guess is the water issue from that standpoint, because again, they're placing an AI data center in a place which isn't really super water friendly. And Tucson's a little bit more. Do they really want a big, massive complex right out there? I don't know. Um, it's an interesting thought process, but I think for new data centers going forward, the availability and the cost of power it is an enormous issue because the cost of power can it can make your data center project go from very profitable to very unprofitable fairly quickly. So you need to have stable source of power. So I mean, my expectation is you're going to see data center companies coming in, and when they put together a plan for a data center at a location, they also are going to co-locate a power source very, very close.
And what was interesting too, when you mentioned the one in Utah, um, was that they originally talked about putting a nuclear power plant there and
Correct.
changed it.
Correct.
So yeah, I'm really interested to see what happens there. I mean, Utah is another place where there's not necessarily a ton of water. There are in some areas, but there are areas of the state that are very,
Dry, which is
very dry.
this is a drier part, which is why I think because of the availability or the lack of availability of water, I think that's why they opted for the natural gas fired plant because you don't really need water for that, at least as much. So um, it will produce the power and electricity, which then will fund or power the entire AI data center.
So one final question here that I've been seeing floated around different articles around the internet is AI, is all of this a bubble? And is it potentially bigger than the dot-com bubble in the late 90s?
It's a good question. Yes and no. How's that for a solid
It's
answer?
great.
So yes, I do think certain companies are in a bubble. I do think that um, certain areas have run up pretty significantly. What we have to understand is AI as a technology can continue to um, be adopted at a rapid rate. It can continue to innovate at a rapid rate, and yet the stock prices in those companies don't necessarily have to follow suit. We found that in the 2001, 2002 era of the dot-com bubble when, the adoption of the internet continued to skyrocket in exponential fashion when their stock prices all fell by 75%, right? And then it took 10 to 15 years to come back to break even. Just because the underlying technology is going forth and doing quite well does not mean that the stock prices in those companies cannot be overvalued to an extent that they just get ahead of every optimistic forecast. Um, I think certain companies are there, if not bordering on there, really, really closely. Um, and do I think that these large companies, the current leaders in that area, are going to be the eventual leaders? I don't think so. I mean, just from my experience with a couple of other bubbles in the past, it's never the initial leaders that eventually lead. Okay. It's, um, so we'll just see. We'll just see how it goes. Certain of the very, very large companies will definitely be in the mix. Um, I think they're innovative enough. They have enough cash flow to fund a lot of stuff, and they can just buy a lot of the innovative AI companies that come about. So, are they going to be in the mix? Yeah, I think they're going to be in the mix. But I think for in stock investors, you want to find those companies that are going to use AI in whatever fashion to better their product, their service, their delivery, their customer service. They're going to basically use it to cut their costs and increase the satisfaction with their clients and meeting those client demands. Um, and I think it's going to be I think the US economy is going to go into a Goldilocks era where you have low inflation, you have excuse me, sorry. My fun little video camera decides to turn off on me every once in a while.
Hey, different view.
Different view because it's now on my, this is crazy. I wish we could figure out how to get this. Um,
It's all good. We just see more of your blue shirt. It's fine.
yeah, okay.
Stick
Well,
with it.
yeah, we'll stick with it for now. But I think that we're going into a point where we're going to have a lot of labor productivity growth. And typically, when we have a lot of labor productivity growth, the equity market grows really nicely. Economic growth grows nicely, the inflation rate's pretty low, and that it becomes that quote unquote Goldilocks era of innovation. But that doesn't mean we can't have a bubble or two along the way. And so I just want people to maintain that, or just understand that right now, with a highly concentrated portfolio, for example, if you own, the S&P 500, NASDAQ 100, and Russell 3000 ETFs, that's your large cap exposure. Guess what? Everything owns the same thing.
Right.
You own all the same stocks. So that's not a lot of diversification. So I wouldn't expect that to do well if if those tech stocks pull back. We started to see a little bit of cracks in that over the past 4 or 5 days. And then today, what really took off was small caps, the
Mhm.
small innovative companies. The larger companies that pay dividends really took off today too. Again, those areas that were lagging up until now have really started to catch up. And that's something that I think clients need to take a look at.
And along with that, one of the things I mentioned, oh, we weren't recording yet, I don't think. But the adjacent industries, right? So, and we actually, when I was thinking about this, we talked about this probably a year ago, or maybe
Mhm.
even year and a half ago, about the industries that are actually adjacent to and supportive of these data center builds. We might have even been talking about semiconductors at that time, which again, still, that's all related, right? That's all related to AI chips in large part. So, is there, is that the place to be looking as well? Or those supportive co co-growth industries?
Yes. One, if you remember about it, maybe a year or two ago, we did a podcast. We talked about the different innovation waves
Hmm.
that will happen, the different stages of an innovation wave. The first is infrastructure, and we saw that with NVIDIA. We saw that with all the companies, Oracle, Microsoft. They're the ones that actually develop the infrastructure, right? They do cloud computing, they build the chips for the data centers. You had, a couple companies that built the servers that would be able to house AI. Then it moved towards the application, right? So that's when you had the chat GBTs developing the large language model. You had, Amazon, Google, Microsoft, I mean, everybody is now coming out with their own large language model to help everyone do everything, right? And we started to see the first crack of applications in customer service, where the chatbots, where you go to a website for a company and automatically it says, "Hi, I'm Joe. Do you have any questions?" And that is a chatbot. That is an artificially intelligence enabled customer service bot. So that's really a great way for engagement on a website. However, we are starting to see a lot more services and applications for artificial intelligence coming out, and that's the second stage of the wave. That's the second stage of this innovation wave. Is how are we going to apply artificial intelligence to make our companies better, to lower the cost of operating a company, or to better the service offering or product offering to the client or the customer. And that's the stage we're in right now. And a lot of them are coming out. You're starting to see very specific expert systems coming out in terms of artificial intelligence. One example is using artificial intelligence, autonomous robots to do surgery, and they're having better outcomes than a human surgeon. Now, a human surgeon has to be there to supervise, but again, typically they're very precise, and it's AI, or it's artificially intelligence enabled. Okay. Additionally, you're starting to see it on the battlefield, right? So two very disparate areas where now you have drones that they'll send up in Ukraine, and those drones will stay autonomous for 8 hours of flight, will identify targets, and deploy weapons at those targets autonomously.
Well,
Okay. So that the you don't have one drone operator for one drone. You have five drones that are autonomous in the air, and the drone operator just has to land them and launch them. That's it. Because other than that, they're autonomous and they'll do what they do. They can identify and take out opposition on their own. So again, those are two very disparate areas, and that's just we're just scratching the surface of how we're going to apply this underlying technology in the economy. And it's going to be very exciting, but trying to forecast what our company, Juncture, looks like in 5 years from an artificial intelligence standpoint is almost impossible to predict because of the innovation that's going to take place over the next 5 years using that technology. Um, so, if you want to think of it as a silver lining on somewhat of a black cloud, there are certain jobs that will be taken away because of artificial intelligence, but other jobs created that are not even they're not even being imagined right now.
right. Yeah, that's always the case, right? Like if you told someone, that in the 90s that their child when they grow up is going to be a social media manager, it'd be like, That's what does that even mean? That's not a thing." And yet here we are.
Yep.
Right.
Yeah, they're quite highly paid positions too.
Yeah.
It's not, so you're right. I mean, it's even if you said, "Hey, I'm going to be an influencer." In
What does that mean?
1995, you'd be like, okay, whatever. I mean, how are you going to make money doing that? Well, we've got a lot of them making a lot of money being influencers. So again, lots of jobs will be created.
Yeah. And the the infrastructure piece too, that was the piece that stuck out to me as well with the AI data centers that are being built up. It feels like this is another extension of the infrastructure piece. So it's like you can kind of see how that wave of innovation, it's not like perfectly linear either, right? It's like that curve is not exact. We've got because these are humongous infrastructure projects. They're not small.
No, they don't go in overnight.
Right. So this is another, like you mentioned before, probably 10 years of work at least, to get, some of these places up and running and really like reaching their full potential. It never is, a 1 year or a 2 year project. They usually are quite long.
Yeah. I mean, it's one of the things that if you want to look at the infrastructure, you still have cloud infrastructure that needs to go in even further than what has been announced. Power generation is probably the biggest bottleneck for
Mhm.
AI in the future because until we can buy and put enough power plants in the United States, we're not going to be able to have enough data centers to analyze and to train all the data. We're just not going to. So power generation is one of the bottlenecks, which people getting involved in that area is really critical. Which is why private equity, I think, is opportunistically stepping in and will probably end up getting paid quite handsomely for taking that risk because they're providing capital to a very scarce area, utilities, and they're going to be able to have it pay off, particularly as they co-locate next to AI data centers.
Well, as we see what that growth looks like, and also as interest rates potentially come down, right? That makes a big difference, certainly in any construction arena, um, as well. That's a big deal for construction, with interest rates and private interest rates. All of that. They're all connected as well. So we'll of course watch that. If you are listening and you have any other questions, if that brought up anything for you, anything that you've seen, um, had any like thoughts, anything truly, I think the piece that's important here is the stuff that feels scary and the stuff that when you run across it on your feed is like, oh my gosh, we're all, going to hell in a handbasket. Basically, in those are the pieces that we tend to have a really emotional, visceral reaction about. And those are the questions that we really want to be able to answer and address for you on this podcast to help you feel more steady and not make those big emotional swing decisions on your finances. So send us the stuff. Send me what you see. Send me your questions. Send Brad your questions, and we're happy to hear from you. And I'm actually going to link that podcast we did before on the innovation cycle in the show notes as well, so you can go back and listen to that if you're curious. So, anything else, Brad? Anything else you want to end with?
Nope. I think we've covered it. We've solved the world's problems. So it's time for you to go get some rest and to get your health back a little bit.
Thank goodness, all the problems are solved. We're just really making the world a better place over here. Thanks, Brad. We'll see you next time.
Thanks.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, @expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.